Today, we have our friends and partners at PIMCO to talk about differentiating their systematic approach to value investing and also the newly launched CITs. So it is my pleasure to introduce Raji Manase, PIMCO's Senior VP Equity Strategist, who will be leading the call today. So Raji, take it away.
Great. Thank you, Lee. Great to be here and talk about the offerings that PIMCO has in this space. Today, I'm going to really share three key takeaways that hopefully you find interesting and perhaps bring some new awareness for you about what we have to offer to your equity lineup for retirement plans. Number one, I want to share with you some observations that we have about the equity market today. The concentration risk that we see in the equity markets and what that could mean for equity markets going forward. Number two, as was mentioned, we have a lineup of value strategies, and we think that there's a case for value. We don't think you need a case for value to allocate there. We think it's good risk management to have an allocation to large cap value, small cap value, foreign large value, et cetera. But there's a case perhaps to even have an overweight today, and we'll walk through that. And then finally, I want to give you kind of a 101 on the PIMCO value offering, what we call RAE, which stands for Research Affiliates Equity. We think it's a differentiated approach, and we think the track record shows that the strategy has differentiated itself, not just versus the underlying benchmarks, but versus its peers. And we think we do it in a cost-effective way, which at the end of the day is what many asset owners and investors are looking for. They're looking for outperformance at low fees. So let's talk about the concentration risk in the market. I'm going to share my screen, so hopefully you have some takeaways here. Value investing, valuations, recovery, and how to invest in value stocks today. So first, let's talk about the S&P 500. No doubt, when you have a plan and you're looking at all of the major asset classes, U.S. large cap equities tends to be the biggest one. We tend to be home market biased. These are the largest liquid stocks in the U.S. equity market. And for many decades, it is quite normal for the largest names, the biggest companies, essentially, to be a big part of the S&P 500. And what that means is, as goes those names, from a performance perspective, so goes the S&P 500's performance, the underlying benchmark. And what you see here on the left-hand side of this slide is that the top five, for example, largest companies in the S&P 500 over time since the early 1980s have usually been 10 to 15%. So I think sometimes when we have market observers and participants say, wow, the top five names are a big part of the index. Well, they're always a big part of the index. That's normal. What's not normal is for the top five names to be more than 20% of the index. And what that means is that you tend to have all your eggs in one basket. Today, we've kind of deemed the top seven largest companies in the S&P the Magnificent Seven. These are the seven largest stocks in the S&P 500. They're growth stocks, and many of them are technology or what I'll call technology adjacent companies. So these are Apple, Microsoft, Amazon, NVIDIA, Alphabet, also known as Google, Tesla, and Meta, often referred to as Facebook. These seven largest names, Magnificent Seven, occupy a big part of the S&P 500. We line this up versus the NASDAQ composite. And why do we do this? Well, the NASDAQ is not known to be a broadly diversified representative index. It's known to be a tech sector fund or a tech-oriented index. And what you see here is that the top seven holdings of the NASDAQ are exactly the same names as the top 7 holdings of the S&P 500. And so what this means is that these 7 names can explain a lot of the returns when they are that dominant in the index. And indeed, that's what we've seen over the past year. We've seen these 7 largest companies start the year at 27.5% of the index, but they've explained 80 to 90% of the returns of the market this year. And what that spells for us is a market that doesn't have a lot of breadth, that doesn't have a lot of leadership beyond these names. And what that could mean is that the market can be a bit more fragile. It could be more susceptible to single name performance as opposed to the entire equity market. Now, we also look back in history. I showed you how the top 5 holdings have fluctuated over time since the 1980s. What about the contribution of the top 10 holdings of the S&P 500 return since 1990? Well, what we see here is that this year, 2023, as of the end of September of this year, we've seen the top 10 companies contribute, as I said, 80 to 90% of the returns of the S&P. And when you line that up versus every other year since 1990, you're essentially looking at the most concentrated market since 1990. And so that narrowness of the market, lacking breadth, is unprecedented. Now, if you were to take these 7 stocks, let's talk about the Magnificent Seven again, and you kind of made them their own country by market cap, they would be the 3rd largest country in the world. Those 7 stocks, which have a market cap of nearly 10 trillion in size, are larger than the 3 largest European companies or countries combined, larger than the entire publicly traded market of Japan. So just as far as a scale and a perspective, these 7 largest companies take up a massive space in global equity markets. Now, history, again, I think is pretty instructive when looking at how the dominant, or what we'll call top dogs, the dominant stocks tend to fare over a decade. And as I said, these Magnificent Seven stocks are just some of the top largest companies in the world today on the far right of this slide. But if you kind of roll the clock back to 1980 and you said, what were the Magnificent 7 or 10 of 1980? Well, mostly they were not technology stocks. They were oil stocks. They were industrial stocks. And that was the result of what happened in the previous decade, the 1970s, the oil crisis, the tension in the Middle East. And the price of oil was high. The profits of these oil companies was also high. And therefore, they commanded premiums in the market. But as we know, in the 1980s, saw moderation in the price of oil, saw prosperity more broadly return to the United States. And 8 of these largest 10 companies underperformed the market by 1990. Why do we know that? Well, they dropped out and they were replaced by the outperformers of 1980 in the 1980s, which were Japanese stocks. In fact, almost all of the largest companies in the world, again, the Magnificent 7 or 10 of that era, were Japanese companies. And why was that? Well, a narrative there was that these companies were better run, better managed, more efficient, and that they were going to dominate the world from a business perspective. That narrative, of course, was true for some time until it wasn't. And those stocks, in fact, 8 of those 10 stocks underperformed. We now know in retrospect that it was a bubble. And by the end of 1990, the Japanese equity market bubble had burst. But those stocks were also replaced by 2000. And by the year 2000, you had, of course, the dot-com bubble, and you had many of the largest companies there, growth stocks, consumer stocks. But of course, over the next decade, by the time that the global financial crisis happened and the aftermath in 2010, seven of those 10 stocks underperformed. And they were replaced by the new sort of peak oil theory. Oil was approaching $140 a barrel, and the rise of China was the key narrative by 2010. Then the rest of the story is a little more recent history, and you remember and you know that the FANG stocks started to dominate, and here we are just 3 years into this new decade, and already three of those top 10 stocks of 2020 have dropped out. So the lesson here is not that these narratives aren't true. The lesson here is that these narratives can often be priced to perfection within the equity market. And more often than not, even if the narrative is true, those stocks can underperform if starting valuations are more challenged. And this kind of brings us to valuations and value investing. Growth stocks in general are better run companies. They're higher quality companies. They have what Warren Buffett calls the moat around the castle. They have cash on the balance sheets. They're masters of their own destiny, and they are forging new ground. That's how I would describe many of these Magnificent Seven stocks and the promise of AI, which we absolutely believe is a promise to come true. However, the question is not the narrative and if it's true or not. The question is the price that we're willing to pay for that. And as you see here, what you're looking at on this slide is the relative valuation of value versus growth. What does that mean? Well, because those growth stocks are usually better run companies with more cash on the balance sheet, more profitability, they deserve and command a premium. And value stocks tend to be slower growing, lower quality in some cases, and they tend to have a smaller premium. And what that means is that what's normal is that value has a 75% discount, more or less a 75% discount to growth. So, roughly speaking, for every 1 unit of growth, you have to put up 3 units of value. So, growth stocks are more valuable. What's not normal is when value gets to be 85% of a discount to growth, or a 1-to-7 ratio as in terms of valuation. And that's when perhaps the good news in growth tends to be more than priced in, or the bad news in value tends to be more than priced in. And what we typically find is when value is trading in the narrower discount, it always trades at a discount. That tends to precede when value underperforms. So 2007 was a peak valuation for value. And when value is trading this cheaply, in fact, at the 96th percentile since 1963, it tends to predate or presage outperformance for value. Now, if you're on the phone and you're saying, well, I heard value was cheap 5 years ago, you would have been right. The question is, what's the catalyst? What about today's environment could be a catalyst for value to outperform growth? Well, one of them is inflation. Now, inflation is moderating. We saw another data point today on employment, and that's good news for the economic picture. However, what we find is that even if inflation is moderating, in decades where inflation is above 2%, 2 to 4%, which is these dotted lines on the slide going across, what we find is that value outperforms growth by 2 to 6%, with the exception of 1999, which impacted the 90s. When inflation is between 2 and 4%, Value tends to outperform growth by 2 to 4%. And that's good news if you own a value strategy. So that could be a catalyst today. So I told you about the concentration risks in the market. I told you about the valuation of value today. Let's talk about PIMCO's approach to value investing, which we apply to US large cap, small cap, international, and in fact, emerging markets. Now, we in this space, you know PIMCO for fixed income, and we believe we are the premier fixed income shop in the world. However, what you may not know us for is our equity lineup. And in this case, we have partnered with Research Affiliates, our next door neighbor here in Newport Beach, California, and their approach is nearly 2 decades in the making. What they seek to do is generate consistent returns like you would expect from a traditional active manager, but in a systematic and disciplined way. So what does that mean? Well, let's take US small cap. Roughly 800 stocks tend to be in the universe. So how do you construct a compelling, high conviction, highly consistent equity portfolio that's value oriented? Well, you start by selecting stocks that are cheap using a value signal. And the two sort of pitfalls in buying cheap stocks are value traps. So quality, we think, is really important today. Look at the regional bank crisis earlier this year. Simply buying cheap stocks would not have been enough this year. Adding quality keeps you out of the value traps. And then the other guardrail, the other pitfall of value investing is catching the falling knife, buying the cheap stocks that are getting cheaper. And so we look at momentum. Value, quality, momentum come together, integrated, and select the stocks for the portfolio. Call it 125 to 150 stocks. Once those stocks are selected for an RAE fund, whether it's large, small, international, or EM, the stocks are weighted based on the strength of that score. Let's call it conviction and the fundamentals of every company. So while this is systematic, there's no black box. It's not opaque. It's not mysterious. The cheapness of the stock with the quality of the company and the momentum of the stock come together to select the stocks for the fund. And then the fundamentals, same fundamentals, by the way, that stock pickers look at, the company's sales, the company's cash flow, the dividends and stock buybacks that are happening over the year, and the book value adjusted for intangibles given our information economy. These fundamentals of every company, bottom up, drive the weight of every stock in the portfolio. And we don't trade the portfolio every day. This is not a high turnover portfolio. You can think of turnover as 40 to 60%. And as stock prices move, and as the fundamentals get updated in the model, the portfolio harnesses and reaps the rewards of stocks that have gone up and takes advantage of stocks that have gone down. You can set a clock by this consistency of process that's applied in an RAE portfolio. And then the question is, what are the results? How is it done over the past 1 to 2 decades? Well, the long story short is it's done very well. And what you can see here is our lineup of US large cap value, small cap value, emerging markets, international, and global ex-US, which includes international plus emerging markets. And what you see here is that in nearly every trailing period for nearly every portfolio, you've seen strong excess returns. Now with the RPAG network and our partners there, we actually have CIT offerings that are at a discount to our mutual funds that are available to you. So specifically, RAE International is a CIT available to you at a preferred pricing. Now, one question we get for that portfolio is, it seems to be the only fund that's underperformed its value benchmark. What I would say there is that if you were to ask me, in fact, we get RFPs, and I get the question, describe the kind of market in which you may underperform. If you were to say that the market was up 32% and we were up 28%, that is within the realm of my expectation. When markets are up 30 to 40%, historically, that's when we tend to lag. However, we think that there's great potential in that fund as markets mature and as the cycle turns. But what you see is in more moderate return environments, 4 to 10%, the strategy tends to be very well performing. And one of the other profiles that we have for the performance of the funds is not just good trailing returns, because certainly you're looking at this and you can't bypass performance. Your clients can't bypass performance. So another lens to look at performance is the consistency of returns. What does that mean? It means you, like me, are investing in your 401k every 2 weeks, every month, every year, which means you have a new start point for your investment. A consistency of experience allows you to have a smoother ride. And if you looked at every 5-year period for the past 1 to 2 decades on a monthly basis, the funds, the strategies have an 89 to 97% success rate. So what that means is that whether your client is investing this month, next month, or the month after, and in fact, hopefully they are, 89 to 97% of the time, the strategy is successful. And the average alpha annualized after fee is 1 to 2%. So trailing returns often gets us a seat at the table when there's a search, but the consistency of the returns is what keeps us at the table when it comes to our clients. The other sort of performance comparison, which I know is really important, are peer rankings. And what you're looking at here are the Morningstar peer rankings, where 1 is the best and 100 is the worst. And what you find here is that since inception, we're seeking to achieve top quartile performance across all of these different strategies. Those rankings can vary depending upon the trailing period, but what you see here is since inception, nearly top quartile performance in every single fund. That's the kind of returns that you expect from your active managers, and the consistency of the process and the consistency of the performance we think is behind the superior peer rankings. And importantly, this is delivered at bottom quartile fees. So we often tell our clients that RAE seeks to deliver you top quartile performance at bottom quartile fees. And these are the mutual fund fees, institutional share class you see across the slide here. Of course, for RAE US Small and RAE International, you can inquire as to the CIT pricing as well. But even from a starting point, the mutual funds, we find them very attractive. So to simply summarize the comments that I've made today, number one, we observe concentration risk in the market. There's nothing wrong in owning cheap beta with the S&P 500, but we think it's important to complement that given the concentration, the unprecedented concentration of broad markets like the S&P. Value investing can be a great complement to broad market exposure. There's a case for value today. It's in the 96th percentile of valuations. There's an environment which could favor value investing, higher inflation and higher rates. And RAE's approach has generated high quality, consistent performance at bottom quartile fees.
Thank you so much, everyone. Thank you, Raji.
Thank you. Have a great day.
Thank you. Bye-bye, everyone.